Michael Burry is, of course, one of the most famous stock traders of our time, really known mostly for his ability to accurately predict the 2008 mortgage crisis, which of course led to the Great Recession, where he famously shorted the market and became quite famous for it. In fact, they even made a movie about it later called The Big Short, where he was played by none other than the great actor Christian Bale. Now, personally, I've never been a big fan of Burry's trading style. I don't have any opinion on him as a person, but when it comes to stocks, I'm much more of a bullish, long term minded investor, whereas I've always kind of felt like Burry is more of a short term minded trader that really tries to make bigger plays on fewer stocks, either going up or down in a shorter period of time, and really just kind of looking to make those faster, quick profits on those. And I'm not saying that there's anything wrong with that. I, of course, think that everyone should be doing whatever they feel they're best at. But for me, that's always been long term investing, buying great stocks at good prices and holding them for as long as possible. But anyway, regardless of any of that, Burry has, of course, had some big periods of success, having founded the investment firm Scion Asset Management, which he is still the current CEO of and holds over $230 million of assets under management. Now, obviously, this isn't as large of a firm as some of the other giants that we typically look at, like the ones of Warren Buffett or Ray Dalio or BlackRock and others, but it's still pretty big nonetheless. And in today's video, we're going to be taking a look at the top 5 largest stock purchases that Burry made in the most recent quarter. And as always, I'll give you my own opinion on each of those stocks, and I'll even rank them from best to worst as we go through the list. So hit that like button if you enjoy these videos. I always have a blast making them for you, but let's not waste any more time. Let's go ahead and jump straight into 5 stocks that Burry is buying. All right, so going from smallest to largest position in the portfolio, purchase number 1 from the last reported quarter was actually a Chinese stock in the e-commerce giant JD.com, ticker symbol JD, which Burry was actually adding to for several quarters before selling out of it in the previous one, only to buy right back in this time as well. So you can see how he kind of just tends to trade in and out of stocks at times. Anyway, he added over 125,000 new shares, bringing the stake up to over $3.6 million and worth over 8% of his overall stock portfolio. Now, when it comes to JD, I've always kind of liked them for several reasons, but refused to invest in them for one simple one, which I'll get into in just a second. But as far as what I like, well, the Chinese e-commerce market is the largest in the world at over $3 trillion and is close to 3 times the size of the next closest market, which is America. So there's a huge gap there, and it's almost on another planet when compared to other countries excluding the US. So it's just such a massive market, and it just so happens that JD controls the second most market share of China, only behind the other behemoth known as Alibaba, which financially it's helped them put up some nice growth over the years, as they also expanded their impressive logistics network into one of the largest in the entire world, with over 1,600 warehouses that actually use some very impressive technologies like robotics and AI to serve more than 500 million active users in the country. On top of which, JD has also been working on new growth initiatives for the future in areas of cloud computing, fintech, healthcare, and more. However, by far the biggest part of their business is still their retail segment that accounts for 84% of revenue. But because of the struggling Chinese economy post-pandemic, JD has also been registering sales growth of just a mid to low single digit in most recent quarters. And as such, the stock has now crashed by almost 75% from the top and continues to trade at one of the lowest prices of the past decade. So I can definitely see why a trader like Burry would want to buy the stock now as an undervalued kind of turnaround play. And I would even consider it myself too, if it wasn't for just really there being a better alternative out there in Alibaba, ticker symbol BABA, who I just think is an all-around better play, as they are much more profitable at more than 5 times the free cash flow. They're still growing faster at a double-digit revenue growth rate expected this year versus negative growth for JD. They're more diversified with the largest cloud platform in China, and they've even done a better job of expanding internationally as well with its Southeast Asian marketplace Lazada, its Turkish marketplace Trendyol, and its cross-border marketplace AliExpress. Even the other big rival of Pinduoduo has done a much better job than JD, at least in my opinion, with their red hot discount marketplace Temu that was actually the most downloaded app of 2023 in America. But sticking with Alibaba, their stock is also down a huge amount and trading at one of the lowest levels that I've ever seen, so I would just rather put my money there instead. Again, I don't have anything against JD, and I do think that the market is big enough for multiple players, but I just prefer Alibaba overall. I'll still be nice to JD though, and I'll rank it somewhere in the middle for now at number 3 until I see what else is on this list, because I do actually think that they'll have a nice little recovery when the Chinese economy ever lifts back up. Moving on to purchase number 2 though, we have a stock here that I've actually never covered before on the channel, but it was a giant increase of nearly 400% to his position, and that was Euronav, ticker symbol EURN, which Burry increased by nearly 5 times the amount, bringing the stake up to over $4 million and worth over 9% of his overall portfolio. Now, if you've never heard of this one before, they're one of the largest oil tanker companies in the world that both stores and transports oil across the oceans. But as you would probably expect, their financials have been super volatile during the pandemic, with huge losses in 2021 because of the decrease in travel and demand for oil. 2022 did see a large recovery though, and this year should be another 40% rise in sales. However, that's expected to fall once again next year, while earnings per share are also expected to drop by 13% on average over the next 5 years, which is pretty bad. It's probably due to the weakening macroeconomy among other challenges across the industry, but regardless, it's not looking good there. And yet the stock is actually trading near an all-time high after skyrocketing last year. And while the dividend is also very high at over 9%, it frequently gets cut and is just as volatile as their financials. So to be honest with you, I don't really know what to make of this stock. I usually stay away from oil and gas companies in general just because they're really just a bit too volatile for my taste, and I really just feel like they're probably better cyclical swing trade options rather than long-term investments. So I think I'll be sitting this one out too. The valuation is cheap though, so I'm sure Burry is trying to make a value bet here similar to JD, but with the stock price up so much, I just wouldn't feel confident investing at this time. So it's gonna get the worst ranking from me at number 5 for now. Next up on the list though, well, wouldn't you know it, we actually have Alibaba, ticker symbol BABA, which Burry followed almost the same identical pattern with as JD.com after buying it for a few quarters and selling out of it, only to buy right back in, this time for over $4.3 million at just barely under 10% of the portfolio. And yeah, like I said before, I not only like Alibaba more than JD, but I actually like them more than most other stocks in the market too, just in general. See, Alibaba is a giant behemoth that has also seen their stock price crumble, despite what I feel is a business that is very much still thriving and putting up unbelievable numbers. With last quarter, for example, seeing their already massive sales growing by another 8% plus, while operating income and net income both skyrocketed by over 30% and 200% respectively. Now mind you, this is not just an e-commerce leader of China, but in fact, they're the biggest player in the entire world at even double the size of Amazon by gross merchandise volume, which is kind of hard to believe. So to still be growing by this much is pretty remarkable. And yes, their business is slowing down coming off of the pandemic, but those were extraordinary years of lockdown-fueled growth that were already way too high to begin with. So to recover now back up to around a double-digit growth rate going forward is very impressive. And yet the stock still fell post-earnings. It's at one of the lowest prices of the past decade. The market cap is like 8 times smaller than Amazon, and the valuation is at a PEG ratio of well below 1, which is a fantastic value, while the stock price itself is also trading much lower than even the lowest analyst price targets. So while it remains high risk because of being a Chinese stock with a VIE structure, I still think it's worth the gamble, and I'm siding with Michael Burry on this one. It's easily the best stock that I've seen so far on the list, so I'm giving it the number 2 ranking for now, above the other two. That will, however, leave us now though with the final 2 stocks of the list, and coming in at purchase number 4, we have a very interesting stock here and a brand new addition to the portfolio. in Booking Holdings, ticker symbol BKNG, which Burry added over $4.6 million worth, bringing the stake up to over 10% of his overall portfolio. And the reason why I say that this is so interesting is because it's the biggest rival to Airbnb, which is one of the most popular growth stocks in the market. But whereas Airbnb does the majority of their business just on that one single platform, Booking actually owns several different brands that are leading their respective markets, including the namesake Booking.com, which is a travel booking brand. They have Kayak for travel search, RentalCars.com for booking rental cars, Priceline, which is a discount online travel brand, OpenTable for dining reservations, and even Agoda for the Asian markets as well. Together, it's made Booking Holdings a very well diversified company with a very strong business and impressive financials that have already seen a huge recovery from the pandemic lows back up to a record high, with sales still expected to grow by almost 25% this year and another 11% next year too. Guys, that's very impressive for what is already the market leader. Now, they do face heavy competition from both Airbnb and also Expedia, who by the way also owns a few different travel brands. But despite that, Booking has shown resiliency in the market with almost 35% market share versus Airbnb at 23% and Expedia at just 11%. And despite that, analysts still expect earnings per share to rise by over 27% on average over the next 5 years, which is helping drive down that valuation. Unfortunately, the stock price itself has already skyrocketed by over 70% this past year to a new record high, which has driven up the current PE ratios to around 40% higher than the sector. But thanks to that EPS growth, their more forward-looking PEG ratio is actually about 30% cheaper, if you can believe it. And man, I really want to be a buyer of this stock myself. I actually feel really dumb for not buying it on the dip when I had the chance, but I just can't bring myself to do it now when the price has already risen by so much back up to an all-time high, especially after seeing just really how easily travel stocks can be destroyed by the government whenever they feel like implementing lockdowns. Now, granted, I don't think that we're going to see mass lockdowns like that again, at least not anytime soon. But then again, I never really expected the initial lockdowns to happen in the first place either. So with the economy so weak and potentially heading for a recession, which could also hurt travel stocks too, I just feel like I need to be more cautious with travel stocks going forward and only buy them on big discounts. I still like it a lot more than anything else on this list though, except for Alibaba. So I'm going to push Baba up to number 1 and squeeze Booking right behind it in at number 2. All right, and finally, guys, that's going to leave us now, though, with the last purchase of the list. This is coming in as the largest of the 5 holdings, and that's going to be none other than Nexstar Media Group, ticker symbol NXST, which I don't think I've ever covered before on the channel either, but Burry decided to more than triple his position on it last quarter, bringing the value up to almost $7 million and worth over 15% of his overall portfolio. Now, if you've never heard of this one, they're actually the largest owner of local television stations in the United States, with around 200 different stations across over 100 different markets and serving close to 70% of households nationwide. They even own a majority stake in the CW network, News Nation, and The Hill, as well as broadcasting rights to other giant networks like ABC and Fox. And they were even in the news recently for possibly taking ABC off of Disney's hands too, although nothing seems to have materialized quite yet. I wouldn't get too excited about that though, as legacy TV networks have actually been a drag for most media giants like Disney and others for some time now. But to their credit, Nexstar has at least pushed more into the digital space with 240 mobile applications, 126 websites, over 780 social media pages, and 6 streaming services available on all platforms, with their digital news properties also ranking in the top 10 alongside other giants like BuzzFeed, CNN, and Fox News. And so far, that combination of legacy media coupled with the new digital media has actually been working for them, as they've broken new revenue records in 10 of the last 11 quarters, while also posting solid growth on profitability in most years too. However, this year looks to be a decline given the weak macroeconomy and struggling advertising market, which caused the stock to dip about 30% from the top, leaving behind a bit of a mixed valuation where it's cheaper on PEs but more expensive on PEG compared to the sector. I don't mind the stock myself. I think it's usually a pretty good performer, but if I want more exposure to media, I'd much rather invest in companies like Disney, Amazon, or even Apple that are all much more diversified with stronger brands and a growing presence in digital that will likely get much larger over time. And because of that, I'm ranking this one behind JD at number 4, which gives us our final rankings of Alibaba at number 1, which is risky but has more future potential than the rest. Booking at number 2, which is a very good stock that I just wish I would have bought on the dip. JD at number 3, who would be better if Alibaba didn't exist, and then Nexstar and Euronav at number 4 and 5 respectively, who I just have almost zero interest in myself. So yeah, overall, not too excited here about the moves from Burry. I think Alibaba and Booking are solid, but the rest I just really don't understand, which I've kind of gotten used to with Burry. Just feeling like I don't usually agree with his trades and his moves in the market. But hey, that's okay. We all have our own different investing styles and strategies, and that's what makes stock market investing and trading so much fun. But I'd love to hear what you all have to say down below. Do you like any of these moves here? Do you own any of these stocks? Again, I own Alibaba myself, but that's the only stock on the list, and it's a bit of a riskier one too. But I'd love to hear what you all have to say down below in the comment section. Let me know. Thanks again for stopping by, my friends. Thank you for all your support. It means a lot to me. And I will catch you in the next video. Hope you're all doing well. Take care. Bye-bye.